If you take a glance around, it is evident that things have changed. There have been many shifts and transformations, most of which have been positive. If you've been around long enough, you'll have seen that the financial world has changed dramatically. New digital assets like cryptocurrencies and more easily accessible investing platforms have positively impacted the financial landscape, making it easier for investors to participate. The good news is that this is merely the beginning. From a long-term perspective, investment has a lot of untapped potentials. So, in this video, we will discuss the 5 ways investment will evolve over the next decade. If you are new to this channel, hit the subscribe button and bell notification icon to ensure you don't miss any of our videos. Number 1. Investing in the future will become increasingly digital. Investing will take on a drastically different shape in the future as a result of advances in technology. This decade will see a major deterioration of the old investment approaches, and traditional investment methods will almost certainly be surpassed by digital ones. As predicted, investors prefer to work with a robo-advisor rather than a traditional financial advisor. This type of financial software or digital investing platform uses algorithms to produce financial advice and is known as a robo-advisor. Robo-advisors are self-sufficient and seldom require human oversight. Robo-advisors, particularly in the stock market, are rapidly increasing. In 2020, the robo-advisor industry was in charge of $460 billion investments, which is likely to triple in the next 10 years. However, it is wise to inquire why these new financial technologies are so appealing. The advantages of this change are enormous. To begin with, robo-advisors give investors more control over their financial futures by giving them more alternatives. Before the introduction of robo-advisors, investors had to choose between handling everything themselves or employing a financial advisor to assist them in negotiating the complexity of Wall Street. As you might expect, the first choice rarely works out well if you are new to the financial world. Hiring professionals can put a massive strain on your budget. However, owing to automated investing platforms, investors may get the benefits of skilled management without paying for it themselves. Investors' naive faith in advisors will gradually disappear as financial education becomes more widely available. Investing firms will get the benefits of digitization as well. In the future, new financial technology will allow you more tailored investment strategies. Number 2. Investing fees will go down. Investment expenses will drop dramatically due to the increasing use of wealth management solutions such as robo-advisors. Investors will pay lesser fees due to less face-to-face engagement with investment businesses. Investing in a robo-advisor is possible even if you have a small amount of money. With robo-advisor companies lowering their minimums, the number of people who can invest will keep growing. This just implies that we'll have more investors than we have today. Hiring an experienced financial advisor can cost tens of thousands of dollars. In addition, doing in-person consultations might be expensive from a time standpoint. It differs from robo-advisors, where automated technology carries a bigger burden and human involvement is limited in most circumstances. This results in a cost of 1/4 to 0.5% each year when employing automated methods, compared to typical portfolio costs, which run from 3 to 4%. The difference is stark. Besides, robo-advisors are available with a few taps or clicks. By logging into an app, you may obtain a synergy of professional financial advice and automatic investment implementation. You may adjust your risk profile and portfolio without a third party. Honestly, all of these advantages are worth sacrificing the present for. Number 3. Self-investment in retirement will be more important than ever before. The concept of joining a company at age 23 and working there for the next 35 years is a bit tiresome, to say the least. Within the next 10 years, the retirement landscape will look nothing like it does now. Not even close. Employee loyalty will be rewarded with everything but large pension plans, as nearly two-thirds of pension systems are considering eliminating guaranteed worker benefits over the next 5 years. Employees in the private sector will see defined benefit plans fade away, making way for a new type of contribution plan. What's the difference between the two? First, the company is responsible for retirement, and then employees are responsible for saving for their retirement. Companies will save a lot of money if they have the flexibility to design their own contribution programs. Retirement expenses are rising as the task of funding passes from the company to the employee. As a result, employees in the private sector will be forced to actively manage their savings. By 2030, most people will be using tax advantage accounts to support their retirement savings. It's time to be ready for employers' 401k and IRA retirement programs. In the future, defined contribution plans like 401ks will become the standard for retirement savings. Even though this is good news for employers, it's a different story for those working there. After they retire, individuals will no longer be entitled to automatic monthly pensions. Instead, how much money they have in their nest egg will depend only on how hard they work to save money. Number 4. Younger investors are more likely to make investments. The score between millennials and Gen Zs hasn't been settled for a long time. Rather than inciting another generational conflict, I'd like to know who's better. With regards to money, Generation Z continues to amaze us, and the tendency will continue. Many financial experts believe that in the not-too-distant future, the minimum age for traditional investments will become significantly younger. The upcoming generation of workers and entrepreneurs is hungry for success, as seen by the fact that millions of Gen Zs are just about to enter the workforce. This hunger is already evident, mainly because young people are coming up with many new ideas. Today, there are many ways to make money that don't care if you have an ID or not. The younger generation isn't fooling around when it comes to making money, from YouTube gaming, blogging, coding, and social media marketing. This generation is taking over the game industry, founding profitable enterprises, and learning the subtleties of programming at a young age. People in their early 20s appear to be positioning themselves to generate income early, which will significantly impact the financial industry. In addition, parents are becoming increasingly concerned about their children's financial well-being. If this trend continues for the foreseeable future, many parents will be creating investing accounts for their children and providing financial guidance as needed. Moreover, I think the advantages of investing when one is young are incalculable. Because of the compounding effect, young investors who start investing early have a better propensity to take risks, recover quickly from losses, and see their money expand tremendously. Number 5. Investors will put their money into a broader range of emerging markets and technologies. The next decade will see a massive shift in stock market themes. In addition to new technology and sectors being phased out as others take their place, changing demographics will be responsible for these shifts. Changes in how people act will also significantly affect how they invest. For example, the investor of 2030 will be flexible and able to move around. For those who work remotely, digital investing choices will be in high demand. Traditional real estate ventures that need oversight will see a decline in popularity as more people turn away from them. Then, new age assets such as cryptocurrency will definitely skyrocket. Even tiny digital currencies will spring up and attract investors' attention once Bitcoin's mistrust disappears. What impact will this have on the investing community? Developing technology-intensive industries should be relatively easy in the coming years. These new age assets include electronic cars, chatbots, robots, AI, and biotechnologies aimed at reducing pollution, to name a few. From this list, AI-related industries are expected to have the most growth. We'll see a lot of corporations making robots and spending extensively on virtual reality in the near future. However, shifting consumer preferences will benefit more than just IT firms. Healthcare is projected to prosper as people's awareness of the need for good health and the upcoming baby boom population surge grows. Specifically, a colossal biotechnology sector will be born from the confluence of healthcare and technology. As a result, healthcare stocks should be high on your priority list if you're looking for long-term stock market profits. In the end, these are all just predictions, and it's best to do your own research and prepare for the worst. Save up, invest, diversify, and enjoy. Always remember that money is just a tool and must be enjoyed no matter what. So, what do you think of this? What other investment changes do you expect in the coming decade or two? I really want to know what you think. Share your thoughts in the comment section below. That's it for this video. Before you go, make sure to like, comment, and subscribe to this channel. Also, don't forget to hit the notification bell to get updated on our latest uploads. Thanks for watching and see you next time.